Hey everyone, my name is Ben, lead educator at Lumen Swap, and in this video I'm going to talk to you about impermanent loss. I'm going to break the video down into two. Today's part is just going to be me describing it to you so that you can kind of get your head around it a little bit, and tomorrow I'm going to make one with some demonstrations and a little bit of actual written text on a slide so that you can kind of digest it in a visual sense. Right then. Impermanent loss is basically what happens when you are either providing a liquidity position or you're involved in yield farming. Impermanent loss is the difference that you would have from those assets moving within the pool to if you just held them in your wallet in their native state. So if you've got XLM, LSP in your wallet and you just leave them, you're just hodling, or if you've got that as a pair in a liquidity pool, so XLM and LSP. As soon as you enter a liquidity pool with your two identical assets, we are giving that as a representation with these phones, yeah, so $100 of each, $100, $100. You go into the pool and you think, hey presto, I've got $100 of each into the pool. Immediately, as soon as you go into the pool, what you're doing is you are making the market. Now, if a project provides a market making fund to an exchange, it does this. It provides their native token and it provides the traded base asset. So it might be USDT, USDC, Bitcoin, whatever the pairing that they are going to create. So they give this to the centralized exchange to make the market. With automated market makers, you are providing the market. You, as an investor, you are providing the liquidity, and instead of the exchange, the centralized exchange, getting the fees on the exchanges, on the trades between those two assets, you, the liquidity provider, are getting some network fees. Many of these protocols then say, well, what we actually need to do to incentivize people to come and use our protocol is we need to give a dual reward, or we need to give something as well as the network fee. So we need to give our token. Yeah, so that might be any kind of farming token that you get out there. The problem that you get with a lot of these is they're highly volatile. Initially, when the farm is launched, lots of people buy this token because they are incentivized with the, wow, 4 and 5 figure APRs and APYs. They think that they can get their money back in a very short space of time when they've actually put their crypto in it. They think they can get the returns out very quickly. In most cases, they don't, because most of these farms are indeed just clones. They're just a clone. They change the name of it. It's a clone of Uniswap, PancakeSwap, etc. And they've put some fancy graphics on it. And essentially, it's just an identical clone from something that's already being created. There's been no thought gone into it, no thought gone into the tokenomics, no thought gone into the sustainability of this. So we go into it and we get this initial pump on the price of the token as people are buying it to put into the farm, and then it dumps hard, and it dumps hard, and it will come all the way down, and then it will go to worthless because the emissions are wrong. Now, what this does to us when we provide the liquidity is obviously we buy our $100 of either side. So we have our $100 of farm coin, as we'll call it, and we have our $100 of a stable coin, thinking we're going to be a little bit safer by going into a stable coin. Wrong. What happens initially is our liquidity position actually gains in value because there's the initial pump as people are coming into the farm. So we're going, wow, like our liquidity position is gaining in value. We started off with $100 of each, and now it's maybe worth $300. And we go, okay, if we pulled it out now, we're going to get $300, and we only put in $200. This is sometimes, when people are chasing yields, this is sometimes exactly a strategy that people do, right? Investors do. They go, okay, now I'm going to pull out because I know that this is going to collapse. And they will pull out and they will take that 50% profit. And they're done. And they can do that in a very short time frame because they're trying to judge, as that token is going up in price, what is going to be the point when it starts coming down. As that flips and it starts coming down, if you were to buy your liquidity position at the top there, where the token price has obviously gone up, and it's instead that you've bought $150 of each, then what happens is the token price starts coming down. So you've got $150 of a stable coin and $150 of the farm coin. Now the farm coin is starting to drop in value, so people are starting to sell it. As people are starting to sell it in this liquidity pool that you are part of, then they are getting more of those in the pool. Because you are making the market with your liquidity, you're also providing the stable coin that they are selling the farm coin into. So as the farm coin is going up in terms of its volume, its price is bottoming out because people are sell. So it's going up in the amount that are in the pool, and the amount of the stable coin is going down as people are selling out into stable coin. You are still holding the position, but you can see what's happening. The amount you're getting of the one that is dropping in value is increasing. The amount of one that is stable in value is decreasing. The pool is constantly trying to rebalance, so it's giving you a massive amount on the one side of the one that is decreasing in value, and it's giving you less and less of the one that is stable, or a rough if it's either a stable coin or if it's a asset such as maybe ETH or Bitcoin, or anything that's reasonably stable against this one that's tanking out, you're getting less of that. The total liquidity position that you have, whereas it may have been that when it raised up $300 worth, starts draining fast. Not just on one side, on both sides it's draining out fast, because you're getting less of the one that's stable in the value, more of the one that's tanking, and as that's happening, this is growing up, this is going smaller, and we get to a point where you could have 10,000 farm coins, right, worth nothing, and $1 on the other side. So you basically come out of the pool when you had $200 with zero, absolutely, completely wiped out, and that has happened too many times. Yeah, too many times that I've been witness to, where you put into a position and the whole thing collapses both sides. That, guys, is the absolute kind of limit of impermanent loss. Total loss. Everything gone. You pull out your position, you get 10,000 of a worthless token or coin, and you get, say, $1 or 50 cents back, and you think, oh. And it's just generally the way many of these pop-up farms go, because they see a financial or a money-making opportunity, a crypto-making opportunity. They go for that, and there's no substance behind it. So you've got to be very, very careful. Now, another thing can happen. As the two assets that you've put in, they can actually grow in value. They can grow in value in the pool. But remember what I said about the buying and selling and the trading between the two assets. What's happening is, as like one asset is growing and it's getting quite strong, but the other one's appreciating in price as well. Yeah, people are selling out of this one and they're buying into this one, and that's what's happening. That's what's helping the price increase, because they're buying, right? So there's less of them, but the price is increasing. So there's less tokens as they're being bought in the pool, because people are pulling them out of the pool and putting them in their wallets. So there's less of them, so the price is increasing. Remember, this is an equation, a balance. So this is happening where we're getting the price going up, but the actual number of them going down on the one side, and on the other side, the number of those tokens that they're swapping or trading, the number of those tokens is actually going up. It's going up because they're providing those to buy the others. So you don't get an even balance as you would if those two assets were in your native Stellar wallet. I hope this kind of is sinking in. You do not get, if you just had XLM and LSP and both were going up, if they're in your wallet, they would just both go up, right? You would just get this increase in price. Not if you're in a liquidity pool, because they're being traded and they're constantly rebalancing. So you will get not the same amount of those two at any singular point in the future, unless you have, right, seen both assets grow exactly the same. When does that ever happen? You tell me. When does it ever happen when two assets grow exactly the same? As I've said in previous videos, etc., if you're doing two stable coins, it's the safest way. However, the way farming normally works and liquidity provision that is incentivized, it normally works where the highest APR are on the most volatile assets. So you can pick up some returns if you're putting two stable coins in. You know that your position, your liquidity pool position, is relatively stable, right? It's only going to change a minuscule amount. But the APR on that's going to be very low, 5, 10, 15%, something in that region across the board is generally about right. Now, you go into these other crazy farms, you can make your crypto back in a day. If you're in early, where the yield chasers arrive and they hear about this farm, it's going to launch and there's 10,000% APR, and they think, if I get in quick and the returns keep coming in, because don't forget, you're going to be able to claim those returns in a traditional sense. In a traditional farm, you can be able to claim them, on a minute by minute basis almost. And if you're claiming them, you think, as long as I can get back, what I've put in, this is a gamble I'm willing to have. But what we've got different on Lumen Swap is that we have a longer period of time. So we have a snapshot taken per month, which is then going to give a reflection of your percentage of the total pool. And this percentage of the total pool is going to be a representation of the total reward at the end of the month. So let's just say it's the 20th of November and the snapshot is taken and you have 1%. Then that 1%, you will get 1% of the 1,153,277. Okay, that's what, of LSP tokens, that's what you're going to get with your 1%. A representation, which is about 11,000 LSP tokens, right? Because you've got 1%. If you've got 0.1%, you'd get 0.1% of that 1,152,000, yeah? Simple as. It doesn't work the same as traditional, but the impermanent loss does work the same. We've seen already where since we've started the liquidity provision, what has happened is we've started with different pools, and because the value of the LSP token has come down as people have been selling it to go into the pools, because most people are LSP holders, and they've been selling that asset to go into the pool because they've needed either XLM or USDC to make the 50-50 pair. As they have been selling that LSP out, it's been dropping the price. As the price of LSP has been dropping, we've seen what I've just spoke to you about. The price of LSP has been dropping and the amount of LSP has been going up in the pool because the price has been dropping. People have been selling it in there. So they've been selling it. There you go. There's more of it going into the pool all of the time, but it's worth less. And then the one that is the other side, so the XLM or USDC, right? There is becoming less of that in the pool as more people sell their LSP to get the other assets. More LSP being less valuable, right? And less XLM being more valuable. And what happens is your initial position in that pool is worth incrementally less, incrementally less, incrementally less, until such a time as we see a bottom and the price starts to increase on both assets, when it will then come back. And that, guys, is why it's called impermanent loss. If we saw a 15-cent LSP token to start off with, and it dropped down to 10 cents, obviously, that is a third, 33% correction on that price. We're going to see this rebalancing constantly, but your initial LP position is going to come down. And it's not going to come down necessarily by the 33% as if you had just held it in your wallet, because it's rebalancing all the time. But you are still going to be underneath, and I call it upside down. So from your initial starting stake, whether that's $100 either side, 150, 1,000, doesn't make any difference. Your initial stake will be less than, but when it goes from the 10 cents and it climbs back and it goes above, your stake may actually be worth more than when you began. So I'm not talking about fees here, I'm not talking about rewards, I'm talking about your stake in the pool may actually have a dollar value greater than when you started, but still not as great as if you'd held the two assets. This is where the rewards come in. The rewards are designed by the platforms and the protocols to offset this loss. The intention is that you will be able to take the rewards and they will make up for the impermanent loss difference. A lot of time this doesn't happen, and you might get $100 out and be $600 upside down and kind of go, oh, I'm $500 net upside down at a loss with impermanent loss, and I've only made $100 because it's a farming token, it's worthless. So my advice, and it's not financial advice, but my advice is find projects that are incentivizing you, that have a long-term vision, that have some sustenance to them, some sustainability over a longer period, because you're more likely to see these assets remain relatively stable or increase in value over the short, mid and long term than you would do if you just saw a farming token pop up 10,000% overnight, it crashes, it's not worth anything next week, and your LP, liquidity provision, right, has just diminished to nothing. So this is the first video really just talking about impermanent loss, just so that you can kind of get a feel for it. Essentially, it's the difference in the price of your liquidity position, right, whether up or whether down, against what it would be to keep those two assets in your native Stellar wallet or whatever network that you're on, right, over the same period of time. And then the difference, the percentage difference, is the percentage of impermanent loss. And as I said, it works the same up as it does down. Of course, we don't mind so much if it's going up. We'll say, okay, we could have had this, but we have this, but it's still a profit, we're fine. But if it's upside down and you think, oh, I've only got this amount of rewards and it's not worth very much, and my liquidity position is now half of what it was, it's a loss. And we do not want you having losses. And this is why it's high, super high risk. Anything to do with yield farming, anything to do with liquidity provision is super high risk. And unless you know exactly what you're doing, I would say do not proceed. Do not do it. But tomorrow I will give you a visual representation of this so you can get a little bit more educated. Thanks as always. It's been great speaking to you, and I look forward to joining you tomorrow.